Hey everyone, it's Imran from Options Insight, back with another macro options spotlight. Okay, US markets continuing to consolidate near this 4,000 area on S&P, which it can't really shake off. The tech stocks did lag again after their recent outperformance on the lower yields. They are giving some of that back, but nothing too scary or dramatic just yet. And then Asia rallying pretty strongly on news of Alibaba's breakup, which is lifting hopes that Beijing's regulatory crackdown on corporates may be ending. And that kind of made the Hong Kong tech stocks rally quite hard and took FXI up about 4% yesterday. So, and then finally in commodities, we did see more upside. They were strong again everywhere except natural gas, basically, which still can't really get a bid. But in general, gold continuing to go higher, consolidating from the weakness that we've seen since touching 2000. Oil also continuing on from that sharp squeeze that it had. Lower some inventory drawdown data came out. We've got more inventory data out today. Again, that might fuel some more upside there. And uranium starting to find some support as well. Volatility wise, not a lot going on really. More muted moves than we have seen. A little bit higher in NASDAQ and S&P, a bit lower in Europe. And then in commodities, there's also a mixed bag with nat gas and uranium bid. Most of the other commodities offered and gold unchanged. You can see carry-wise a bit more neutral. We had said that don't get puffed into buying loads of gamma with all this deep negative carry in Europe because implied vols are forward-looking, realized vols are backward-looking. So often, once you've had a load of movement and then the market kind of digests it and moves on, implies then price in the idea that you're going to see a calmer period. And that calmer period is what we're seeing now and are likely to see over next week as we head into Easter as well. And that's where we're seeing the carry shifting back from negative back towards positive and more neutral. So that was something we had already warned about. In terms of gold, that is still moving pretty handsomely in deeply negative carry, but everywhere else in commodities pretty much positive, with copper coming out the highest at 42% positive. In terms of skew, we are continuing to see skew drift lower. So back to a 36th percentile on S&P, which is quite a decent pullback from what we've had. Russell also back to the 40th. Europe still kind of persisting in the 60s. Not quite as keen to sell European skew, the market just yet, as they're fearing what might come out of these European banks with that AT1 bond market still looking a bit ropey. And then if you look at skew within commodities, we're seeing a bit more downside, i.e. call buying, put selling in silver. We are seeing a bit more put buying in uranium and nat gas. Those are your main sort of moves there. Okay, now if we jump over to the charts that have caught my eye, obviously we had some brutal moves in short-term rates over the course of March. And I think these were exacerbated by some rather crowded positioning from both the hedge fund space and the CTAs. They were all very short bonds. CTAs have been following that trend throughout last year, very short bonds, and hedge funds had bought into the idea of higher for longer that Powell himself was advocating, right, not long ago. So that was the crowded positioning that the street had on. We obviously then had the banking crisis and a lot of pain and a lot of everyone trying to exit at the same time and repricing their expectations of rates. Now that things have repriced, and you know, some hedge funds have had their worst drawdowns, their worst kind of months in years, if not ever. We do think this cohort of investors may be somewhat paralyzed in the near term, a bit like a rabbit in the headlights. Whereas, you know, we've also seen positioning data from Goldman's alluding to the idea that hedge funds haven't been doing too much in terms of their net exposure is at 5-year lows, and that hasn't really moved in the last 3 months. So their gross positioning is much higher, but their net exposure is quite low. So that shows you slightly less conviction, basically, right, for like big macro moves. Now, on the flip side of that, we've got CTAs who, whilst have had enormous drawdowns as well, and we're talking about, you know, really multi-sigma type moves in what these guys have experienced, you know, they are less likely to be stuck in their positions by virtue of the fact that they are rules-based investors, and they're just going to do what their models tell them to do, right, and not be emotional about it and not be licking their wounds, right? Now they might have outflows, and that might impact them, but the idea being is they're still going to keep doing what they need to do if price goes that way. So in the absence of any more clarity on the rates front, which we think is only really going to come as we get more inflation data, and then the Fed is going to confirm what's going on with rates and if they are really pivoting. We do think CTAs in the near term are going to have a lot of marginal impact on markets. And the data at the moment is showing across asset that there is certainly some risk to the upside. Should markets move higher, CTAs could have quite a chase on. So we've got WTI here, projections, again, from Goldman's, who are kind of all over this space, projecting what CTAs are going to be forced to do in different scenarios. They're saying if we do get crude oil bouncing and we're starting to see some stability back in that market, and we know there's been capitulation in that market as well, and quite a strong price reaction off those recent lows. If we do go higher, then you've got a lot of buying coming back in from CTAs on the upside in oil. And similar story, if we look at equity positioning, where these guys have got to in terms of stocks, again, on the way up, there's quite a lot of short positioning that needs to be addressed now from the CTA community, and that's changed quite a lot in the last month or two. So we just need to be cognizant that in the absence of the discretionary community doing that much differently, because they need to wait and see the impact of the banking crisis, the impact on inflation, what are the Fed actually going to do relative to what the rates market has priced in. These things are not going to happen overnight, but in the near term, what CTAs do could have a lot more impact in a market that's not particularly deep and particularly liquid right now, okay, with everyone licking their wounds. So that's just something you need to be aware of, and basically says to me that there's still a fair amount of upside risk in risk assets going into Easter as volatility comes down. Vol Control might be a buyer as well, and that might just take things higher, even though it might not make a ton of sense fundamentally. Now, I'm looking at uranium. I mean, obviously, commodities definitely do seem to be where the opportunity seems to be at the moment. If you are, a bull on commodities, you could take advantage of some of these dips that we've seen on structural themes that you like. So uranium's been one that we've liked for a long time. We've been trading the range, to be honest. We got in down here. We rolled some of our position, took some profit up here, and now it's kind of approaching the bottom end of that range again. Our main proxy on uranium is Cameco stock, which is one of the biggest uranium miners, just because it's got the most liquid options market. It's way better than the uranium ETFs. So we like using this stock for our plays in options on uranium. We do also own the ETFs themselves in the long-term book structurally, but when I layer on tactical trades on uranium using options, I tend to stick with CCJ. Anyway, this stock has traded back down towards the end of the bottom of the range. 22 is probably the true bottom of the range, which we haven't reached yet. We got to 24 and bounced. But we quite like getting into some call spreads, looking at the sort of volatility dashboard as a way of kind of gauging what the trade should be. We can see buy calls is kind of still what we're flagging in general. This is on uranium, not on CCJ. But on uranium, we have bounced a little bit in terms of spot, but we're still in low vol territory. So it's still saying buy calls or buy straddles type thing. Now, the problem is with that is it's got quite a lot of positive vol carry right now. So the realized vol is closer to 20, whereas the implieds are still 35. So I'm not a massive fan of just buying outright options. So what do we do to mitigate the theta? Well, there's two things that we do. We don't buy 1 month options. So we're going to park ourselves in June. We're going to park ourselves in the middle of the curve. That's going to keep the theta down. And we're also going to do a call spread rather than an outright call, again, to keep the theta down, to give us a long expression that isn't going to evaporate and decay too fast while we're waiting for this thing to actually start moving, right? But given that we're near the bottom of the range, we do like the idea of maybe getting some extra delta on the book. Now, the type of call spread I generally like to go for is something like, okay, that's it for today's one. Thanks for listening as always, and I'll catch you all tomorrow. Cheers.